All right, we are in. I want to thank everybody for attending another great Money Monday. And today's Money Monday is probably super timely because if you haven't heard all the noise around stock options, this is how you're going to get rich and this is how you're going to make the most money. People that are bragging and they're like, oh, I just made $5,000 overnight and I only had to put in $2 or whatever it might be, then perhaps you're just under a rock. Because it's definitely a topic that we're hearing more and more of. And so many apps and so forth are making it easy to invest in these options. And it could be good and it could be bad. It really depends on your individual strategy. And so our goal here is always to inform, to educate, and to really help you customize a plan that's going to work for you. So there's going to be some people that walk away today and they're going to say, yes, this is a good fit for me. And there are going to be other people that say, I'm glad I know more. Maybe this isn't a great fit for me. And that's totally fine. But whatever you do, we want you to be educated in that mission as well. So we have Jim Solin with us today. And one great thing when we talk about professionals, I am big on we don't just listen to any old body. We want people who have been in the industry, who have some type of accountability and so forth. So president of the Independent Registered Investment Advisor, Solin Sims Associates, and registered principal with Raymond James Financial Services, Jim has over 35 years of experience. So he's seen some market swings. A graduate of the Ohio State University, he earned both designation of Certified Investment Management Analyst and Certified Private Wealth Advisor from the Investment and Wealth Institute through Wharton College of Business and the University of Chicago, respectively. FI 360 conferred Jim with the designation of Accredited Investment Fiduciary. And so oftentimes you'll see the CIMA, CIMA, you'll see AIF. So you know what those mean. Oftentimes we're like, oh, they got a bunch of letters. That must be great. And yes, usually that is great. So he also has his Series 6, Series 7, 22, 24, 51, 63. All those basically mean you can do mutual funds, you can talk about stocks, you can be a supervisor, all of those kind of things. And so all the letters, all the numbers just really back up the experience that we have with us today. And so I want to thank you so much, Jim, for joining us today and giving us your knowledge.
Well, thank you, Rosalind. And being in the industry several years just means you're old. That's all it means. So I do want to thank you for having me today. I'm very happy to be with this group. I'll tell you, Rosalind's done a wonderful job in putting a group like this together. It's a lot of work. And I think it's great that all of you have taken time out of your busy schedule as well to educate yourself on the markets and the strategies that will help you gain that financial independence that you're pursuing. I mean, when you look at education, Nelson Mandela said, education's the most powerful weapon which you can use to change the world. So with that, I'd like to get started here and we're going to talk a little bit about options. Now, options, we could spend an awful lot of time on options. We're just going to have time for a small dabbling in it, but hopefully it'll give you an idea of what to look at. But let's take care of the regulatory business before we get in there and I get all the fine print out of the way. Salling Sims Associates is an independent registered investment advisor. We're not a broker dealer. And while all the financial advice is given through Salling Sims Associates, the investments are offered through Raymond James Financial Services. That is the broker dealer. So Salling Sims Associates is independent of Raymond James. We don't use all of our investments through Raymond James, but the majority of the individual side is. And this presentation is meant for educational purposes. It's not a recommendation to buy or sell any investment, and you should always check with your financial advisor. And I hope everybody that's on here has a financial advisor that you work with. It's invaluable to your efforts. And check with them before buying or selling any investment to determine if it's appropriate for you. And we're not going to be giving out opinions on any particular security today, any particular names, but we'd be happy to discuss that with you offline in a personal discussion after giving you our CRS, which is the form we're required by the SEC. Sailing Sims Associates works with associations, foundations, companies, and individuals, all in matters concerning investments, employee benefits, philanthropy, taxes, intergenerational wealth management. And lastly, yes, we do accept new clients. So with that, we'll kind of get started with options. And there's many types of options in here. And oftentimes you'll see if you have an employee benefit plan that you'll have some employee benefit options. They're either going to be non-qualified stock options or they're going to be incentive stock options. We could do a couple weeks on that, just talking about that. With that, there's mainly the timing and the tax planning opportunities that you have. It's not so much the investment option that you have across here. This is more tax planning and control of that. What we're going to be talking about today are open market, things that you can buy on the open market regardless of any benefit plans. Now in there, some strategies can increase the risk in the portfolio, and understand the options can add an infinite risk if you use them wrong. But some strategies also can decrease the risk in a portfolio. And that's what we're going to be talking about today. When we do get to the strategies, we're going to talk a little bit about those that can decrease the risk in your portfolio and help you build along the way if you're working with individual stocks. Okay, so on Sundays, you go in, and I've had a minister talk about things that happen in the Bible. And I love the two stories about the great investors from the Bible. First was Noah. He was able to float his stock while all others around him were liquidating. And then again, you have the Pharaoh's daughter, because she went down to the bank and pulled out a profit. But I don't think that's exactly what they meant when they were telling those stories, or the words didn't mean exactly that. And so it's important to understand what the words that are being used actually mean and in context. And so that's where we're going to start. We're going to start with a little bit of defining the terms that we're going to be using, and then we'll look at strategies. So the language of options. The first two are a call. The call is the right to buy a stock at a designated price. You can think a call as well, gee, if I told you I'd sell you my house for $100,000, you'd have to make a decision right now. And so that's a very quick market decision. But if I told you that if you give me $100, I will sell you this house for $100,000 for the next year, the full year, and you have that year to decide. And whenever you want, you can decide to buy the house for $100,000, regardless of if the market went way up on this house. So a call is the right to buy a stock at a designated price. The put, on the other hand, is the right to sell a stock. On the other side of that transaction, if I said, I'll buy your house for $100,000, and you said, well, not today. Or you could even say, gosh, my house is worth more than that. But if I gave you money in here, or I'm sorry, you gave me money, gave me $100, then I promised you I'd buy it for $100,000. So if a tornado comes through and wipes that house out, I still have to pay $100,000 for that. So a put is the right to sell a stock at a designated price. The buyer is the person that buys the option. That makes sense. Well, the reason we point that out is the buyer is the one who controls the execution. If you buy a call, you're the one that gets to decide, should I buy that stock at this particular price? If you buy a put, you're the one that gets to decide, should we sell this stock at this price at any particular time? The seller, on the other hand, is the person that sold the option. If I sell you the call, then I have to guarantee that you can buy my stock for that price. And if I sell you the put, I have to guarantee that I will buy your stock at whatever that price is, that designated price. Well, it sounds kind of risky is that seller really going to come through? So there is also the OCC, or the Options Clearing Corporation. This is actually who you're dealing with. when you buy a call, you're dealing with the option clearing corporation. They've got on the other side of that, the seller, and they're the ones, the option clearing corporation are the ones that are going to make the seller sell the stock for you. So you know that you're guaranteed to have these executed when you want to have them executed under the nuances. So what can you execute them at? The strike price. That's the agreed upon exercise price of that transaction. So if I have a call and I say, I'm going to buy a call to buy a stock at $70 a share, and no matter what the price of that stock is, if it's 150, I can still go in and buy it at $70 a share. 70 is the strike price in there. Then the stock price is the current selling price of the underlying stock. That stock that we were talking about, I may have a call for $70, but on the open market, it may be selling for 120. And so therefore I can still buy it for 70 and sell it for 120. That's a pretty good deal if you can. The premium then is what you pay for that option. So that's the market price of the option. The stock price will do the underlying stock, but the premium is what the price of the option is. And we'll see why that's important in a few. And of course, these options are only good for a finite time. They can be good for days, months. You can find them a year or more on here for options on. So we have an expiration date, the date at which this option becomes worthless after which, and it's always the Saturday following the third Friday of the expiration month. Why they say it like that, the Saturday following the third Friday. Really the last day to trade your option is the third Friday, because once market closes on that third Friday, the next day they expire. Well, why don't they just say the third Saturday? Because a month could start on Saturday. So it's always the third Friday at the end of the day. That's when your options expire. A contract. Whenever we talk about contracts, options are priced per share. When you see the prices that are in there, the premiums per share, but options sell in even contracts. And so if I would buy one contract, a contract is 100 shares, I'd be buying 100 times that premium, be controlling 100 shares of stock. If I buy 5 contracts, then I'm controlling 500 shares of stock. Opening trade. That's when we establish the option in the account. Now, we saw that you have a buyer and you have a seller. So I can buy a call or I can buy a put, and that gives me the option to do either of those two things, buy the stock or sell the stock. Or I could also sell the call or sell the put. Now, when I'm selling a put, in essence, you're going to need to have a margin account with your broker to be able to do that. But you haven't bought the put yet, you're sold it. And so if the price goes up or down, you're subject to have to come back in and buy it at some point or exercise it. And exercise means to complete the transaction that you promised by the option, buying the stock or selling the stock. We'll see that that's not always the way that you end this, because you can have a closing trade. And the closing trade is if I bought the option up here, my closing trade would be to sell the same option. I buy it, I sell it, I'm out of it. On the other hand, if I established it by selling, then I would close that trade by buying the option. So you can either close the trade or you can exercise the option. You have the choice. Whether you're the buyer or the seller, you have the choice, and you're dealing with the OCC. In the money. Now there's an old song, and hopefully it becomes an earworm for you tomorrow at work, and you'll drive all your coworkers crazy. I'm in the money. I'm in the money. Think about that. This is the easiest way to think about that. It's when the strike price is better than the market price. So if I have a strike price that says I have a call at $65, but the stock's selling for $70, I'm in the money. I could buy it at 65, sell it at 70 today. Yeah, and it makes good sense. If I have a put that is in the money, if I can sell it for 75 and that stock is selling on the open market for 70, I can buy it for 70 and sell it for 75. I'll do that all day long. I'll make $5 a share for every. So if the strike price is better than the market price, I didn't say higher or lower because it depends on whether it's a put or call. We'll see that again. Out of the money just means that the strike price is worse than the market price. If I have a call, if I buy a call and I have a call for $65 a share, I can buy the stock for 65. But if it's selling on the open market for 60, who cares? You know, that call's kind of worthless to me at that point. So it's out of the money. If I have a put and the put says I can sell it for 65, but on the open market, I can sell my stock for 70. Again, you know, that's worse than the market price. So I'm out of the money. Intrinsic value. This is how we're going to start looking at the premium when we'll see our example. The intrinsic value is the amount of money that the option is in the money. So in the money better. So the intrinsic value is the amount that your strike price is better than your market price. How many dollars is it? The time value then is the value that's assigned to the time until the expiration date. So if I told you that you could buy this stock for $65 this week, you know, that's worth something to you. But if I told you you could buy this stock for $65 until next June, then you might say, well, that's got a little more value because that stock can move in the market over that time. So let's see how these work. We got all the little definitions out of the way. So when we look at a stock, let's say that we have a stock that's priced at $70. If we have a strike price that's $65 in here, that would be an in the money call because we're selling at, or I'm sorry, buying at $5 less than what the stock can sell on the open market. A strike price of 75 would be an in the money put because we can sell this stock for $75 when out on the open market you could buy it for 70. Okay, so those are in the money. That same $75 strike price would be an out of the money call because who would want to buy this stock for $75 when you can go out on the open market and buy it for 70? So that's out of the money. Same way with the 65 strike price. If you could sell it for 65, why would you do that? Because you can go out on the open market and sell your stock for 70. So that's out of the money put. So the same strike price can be in the money or out of the money, depending on whether you're buying a put or a call. Again, the call is in the money if it's below the stock price. A put is in the money when it's above the stock price. So let's look at those ones that are in the money. In this case, this in the money call was in the money for $5. In this case, the in the money put is in the money for $5 because they're $5 better in either transaction, selling or buying, than what the stock price is. So if we look at those, then that is what we call the intrinsic value. The intrinsic value is the amount that the option is in the money, the strike price is in the money. The other value that we were talking about is the time value. So if we put a timeline here, and way out here, we put the expiration date. Now, if we're a long way to the expiration date, our value is going to be more. As we get closer to that expiration date, that value is going to go down until it's zero when you have to make that choice right at the end. You know, that's, it's use it or lose it at this point. So let's just pick a time in here and say, okay, in the middle here, we've got a time value of $2. And we know that by the expiration date, that's going to go down to zero. You know, this time value could be any amount, but understand that the further away from the expiration date, the more the time value is in this option. we take that time value and then we add our intrinsic value that we had from our previous example for an in the money, let's say, call. In here, we add those two together, and that's going to give you the premium. Now, it's not usually the way it's done. You usually see the premium, or what the quote is for the option is the premium. You can calculate the intrinsic value very, very easily by looking at how much better the stock price, or sorry, better the strike price is than the stock. And then you can force what that time value is. And you know that that time value eventually will go to zero. The intrinsic value can go either way. Now, if we were using an out of the money call, we know that there's no intrinsic value there because no one would want to exercise that, but you still have the time value in that particular option. So you may have an option that is out of the money, but somebody is paying $2 for that because they know that they have this option until expiration date. We'll see an example of that in a few minutes. Now, at expiration date, the time value goes to zero. That's a given. At that point, if the intrinsic value is still zero, then the option expires worthless. You don't have to do anything. It just goes away. If you had the right to buy the stock, you no longer have that right. If you had the right to sell the stock, you no longer have that right. If you were bound to that execution, you had to sell your stock because you sold a call on it, then you're no longer bound by that. But that's called expiring worthless. Now, if we get to that time value though, and let's say that instead of going down, that call, the stock price for our call in here, let's say 10% from our example, that value may be $12 then. So at expiration, that can still be worth on that date. Now, if you're in the money a quarter of a point, 25 cents, if you're in the money 25 cents, at the expiration date, the option clearing corporation will automatically exercise that for you. It is an exercise. So if you haven't done it yourself, they'll do that on the expiration date, but that gives you no reason to ignore your options. So in this case down here, if that stock price in our previous example went from 70 to 77 for a 10% growth in there, our option that we had on that previous example, a $2 time value, a $5 intrinsic value, was $7 when we bought it. The call option moved from $7 to $12, or that's a 71% growth in our investment when the stock only moved 10%. This is the leverage that options give. You know what? If that stock instead had gone down, if we had guessed the right way and we had bought the put, our put on that stock that moved from 70 to 63, that's a loss. Our put that had a $7 value in the beginning, $5 intrinsic, $2 time value, because we were saying that we could sell that for that moved from $7 to $12 as well. So we had a 71% growth on the option when the stock had a 10% loss. So this is the beauty of options, that you can make money if the stock's going up, you can make money if the stock's going down, if you're on the right side of that transaction. So let's get that out of the way. We'll say we have a stock price at 65. This is a reason that somebody would buy an out of the money option. So here's a strike price of a call at 70. We know that that's out of the money. So we know there's no value, intrinsic value in that. It's an out of the money call. The time value, we'll just assume we have a $1 time value in here. And if that $1 time value in here gives us the premium of $1 total, 0 plus 1. If the stock price moves to 75, that's a $10 move on that stock. The out of the money call is no longer out of the money. Now it's an in the money call because the stock price itself had moved past our strike price while the option was still alive. So we have an intrinsic value of $5 there. And let's say this happened over a very short period of time and the time value is still $1 on it. We have a $6 premium then. And for the 15% growth in the stock that we had, we now had a 500% growth in our option. And so again, even though we bought an out of the money call, we were able to make 500% on our investment versus a 15% on the stock. Let's look at risk, because how much can you lose if you buy a call? Well, a call is a definite time period that you have it for. So you could lose 100% of what you invested in that option, 100%. But that's all you can lose. Now, remember our $70 stock we were controlling with $7, or in that out of the money call, we were controlling that with $2. So a $7,000 investment, you're controlling with $200. How much can you lose if you buy a put? Well, you can lose 100% of the premium that you put in the investment. But again, that's all you can lose. So you're using a much smaller amount than what the actual stock cost on there. So you may do that and say, I'm willing to lose that. But how much can you lose if you sell a call?
I mean, it kept falling through earlier.
That's an unlimited loss in here, because if that market value went through the roof, whatever happened, they discovered a cure to cancer, and that stock market price went through the roof, you still have to be able to sell that to somebody at that strike price. Then you have to go out on the open market and buy it for whatever the value of that stock is. So here's where your unlimited risk comes in. And how much can you lose if you sell a put? Well, the loss is limited, but it's limited to the market value of the stock at the time of the initial sale, minus what you got in your premium that somebody paid you if you sold the put. So it does have a limitation, but it's much, much higher than the premium on your put. So the thing to remember when we're looking at this is bulls make money, bears make money, and pigs get slaughtered. That's the thing to remember. You can make money as a bull, you can make money as a bear, but if you get greedy in this, it's a real easy way to lose a lot of money. So here's a couple of risk reduction strategies. And the best way to put this reduction strategy in an analogy is think of your home. And you may have a small home, you may have a big home, but if you buy homeowners insurance on your home, it protects the value of your home. And that homeowner's insurance, if you're a small home, costs one thing. If you're a larger home, costs maybe more. But that homeowner's insurance ensures that your house doesn't burn down. But if you paid that insurance premium last year, which I hope everybody did, if you paid that insurance premium last year and your house didn't burn down, you didn't go running out in the street on New Year's Eve saying, I just lost all the money I put into that premium. I lost all the money I paid for that insurance, because it let you sleep the whole year knowing that if your house indeed did burn down, you'd have the money to replace it. So think of that when we say this strategy is a put to hedge. Think of insurance. So in this case, we own 500 shares of a stock. And boy, we've had that stock and it's done well. It's grown from $30 a share to $70 a share. We think it's going to continue to go up. So we don't really want to sell it, but we're worried that it may go down and we'll lose our profit. So we don't want to sell the stock because we think it goes up. But we say, I can take a 10% loss, but I don't want to see my profit go out the window if this thing drops back to $30 a share. So maybe I can let it go down to 63. In this case, while I'm owning the stock, I buy 5 contracts of out of the money puts. For example, in our example, we had a $2 premium for a $65 stock price. And again, this is open market strategies, and the longer you have this option, the higher the time value premium is going to be. But so we buy $2. We take $2 out of that $70 a share price for $65. So that cost us $1,000 because we're protecting 500 shares. So 500 times our premium, $1,000 is what it cost us for 5 contracts. Protecting 32,500 of our $35,000 investment. $70 times 500 is 35,000. That's what our investment is. And we're saying that we can sell it for 65. So 65 times 500 is 32,000. So no matter what happens to that stock, we know that we can take at least 32,500 out of it. Now, if the stock goes up or even closes an expiration date above $65, so even if it went from 70 to 66, remember our time value goes away. If our intrinsic value is 0, we lost our $1,000 premium. But again, just like our homeowners insurance, we know that had that stock burnt, then we would have been able to sell it for $65. But we still own the stock and any additional profit in the interim. So if that stock went from 70 to 85, we've made $15, but our insurance, it cost us $1,000, so in there. So or in this case, $2 against the 15. So we're still have a $13 profit. So then what we do is we go back and we do that again. But if the stock goes down before the expiration date below $65, then that option is worth at least the intrinsic value. And so you have a choice then. We can either sell our stock for $32,500 and sleep well at night, knowing that we didn't lose our money, or even if that stock is worth $3,000 now, or we can close our put position by selling it for the current premium. That's the intrinsic value plus the time value, and we still hold the stock for the rebound. So if that stock went down to $50, we know that the intrinsic value of that put option is $15 better than our $65. I said that backwards. The $65 is better than the $50 market price. So it's at least $15 plus whatever the time value is. We just close our position by selling the put instead of selling our stock. In essence, we've taken our profit out between that current market price and the $65 a share. We now have that cash in our account, and we can take that cash and reinvest it in something else, or even double down on the same stock if we want. A covered call. We own 500 shares of the stock, and it's grown from $30 a share to $70 a share. I'd be satisfied with another gain of 10% between now and 3 months from now, an expiration date. Or the stock's not moving and you want to collect a little. If it's going sideways and we want to get a little more return out of it, we can sell a call. Now, while we continue to own the stock, I'm sorry, this should say call at the top. We sell 5 contracts of out of the money call option. This is still the covered call. For our example, for a $2 premium and a $75 stock price. So the proceeds that we get on this because we sold the call is $1,000. Now, if the stock does not go above the $75 strike price, then when it expires worthless. We do nothing. That $1,000 was always ours, regardless of what happens. So we made $1,000 of extra profit. So we had a stock that could have been going sideways. We sold the call on it, and it still went sideways. We kept putting $1,000 in our pocket. And we can repeat that transaction for as many times as we want. But if the stock goes above the $75 strike price, you may have to sell your stock for $75 a share. But remember, we said, I'm willing to take that profit between now and expiration date. If I get a 15% profit or a 10% profit in 3 months, that's a pretty good return. But during the holding period of the option, you profited that additional 10%. Minus the $5 share, plus $2 the share premium that you already pocketed. So you got 37,500 for the stock plus the $1,000 option premium. Or again, you can always close your position by taking the opposite as you did on the opening. So instead of when you sold on the open, you could purchase that callback for whatever that is. Blending the two strategies, and I'm going to come to a close here real soon. Blending the two strategies, you own 500 shares of the stock that's gone from 30 to 100. In that case, you'd be satisfied with a gain of 10% between now and expiration date, and you want to protect your profit you already had. So in this case, we may sell 5 contracts of out of the money call, get $1,000 for it, and we use that $1,000 proceeds to purchase out of the money put, protecting my downside. So at worst, you've limited the upside to an acceptable rate of return. And at best, you've successfully protected yourself, or you've gotten your insurance on here for free, because the call would expire worthless if the stock went down. So if both contracts expire worthless at the expiration date, you just reinstate that strategy and extend your protection period. You take the expiration date out. But if the stock's gone down but not beyond the strike price, you may want to close both positions and get some positive cash out of the strategy. And lastly, we'll talk about if any of you have used a stop order. Say a stock selling at 70, and if it gets down to 65, I want to buy it. So I put in a good till cancel order of my broker that I want to buy this stock if it gets to 65. Well, if the stock doesn't drive to 65, you don't get that stock and you don't have anything to show for it. So instead, if you sell the $65 put, that's saying that you'll buy the stock if it drops to 65 at 65, the same thing you did with that stop order. But if it does, you buy it for 65, but you've also pocketed a premium of $2, making your net cost only 63 for that stock. And if it doesn't, then you still get the $2 premium, so you made money on that. There's a lot of strategies that you can use, and we can get real intricate. There's spreads and straddles and everything that you can use on this. But if you do like to look at options and all the different combinations that you can do, I would highly recommend this book. It's Options as a Strategic Investment by Lawrence McMillan. It's not a cheap book. It's I think somewhere between $85 and $110 for the book. But when you think about what you'll get out of this book, all the strategies that are there, it's going to be well worth your investment in your investment in time. And Rosalind, I think I'm a little bit over here. So,
No. It's good stuff. We had a bunch of the ladies that joined. A few people said that they're doing some options today, so that's always a good thing. And I think that there are some ladies that are indulging in options today because they're looking at it as another arm of their risk. But then there are probably some of the ladies that are saying, oh no, like this is way more risk than I want to take on. And so for the ladies who are probably a little more conservative, can you highlight some of the times where it makes sense? I know you talked a little bit about that's a great way to protect. So if you are risk adverse and you're like, I don't know, I just do, maybe they just do index funds or what have you. I think this might be a great conversation to have, especially if and we talked about this a little before the conversation started, for some of the ladies who may have gotten like some restricted stock from work or what have you, especially if you've been with the same company for a little while.
Mm-hmm. Well, you typically can't do it with the restricted stock, these covered strategies, because if something happens, you have to sell the stock and you can't sell it because it's still restricted. But once those become unrestricted shares, then you can certainly do it with those. And this is a very, very conservative strategy. And this is actually one that reduces the risk of holding the stock, when you take that put insurance, because when you buy that put, it's the same thing as your insurance premium on your home. So don't think of it as I'm going to lose my insurance premium. Think of it as, gosh, I've got my stock, and if tomorrow we have another 2008, or tomorrow we have a March, this March of this last year, what happens is that stock price goes down, the price of your put goes up, so you can take out all that profit that you had on your stock. So this is a way for a conservative person to actually conservatively lower the risk in their portfolio. The same thing with the covered call. The covered call will limit your upside. So again, it's a conservative. Again, it's a conservative strategy. But for those stocks that are going sideways, or if you want some money to cover your put, that's a way to put money in your pocket and make that insurance virtually free for you. And at worst, you've limited an upside. You haven't lost anything. You just haven't made as much as you could. Remember that bulls make money, bears make money, pigs get slaughtered.
Marie asks a really good question. She says, it seems like a good deal of capital is needed because the options contracts are in 100 share bundles. Is that correct?
Yeah, all options are sold as a contract, and contract is 100 shares. So when you see the price of an option, it's the price of one share, but you can't buy just one share. It's 100 shares. So if you buy 5 contracts, it's 500 shares.
But when you think about it in true terms, especially as someone's thinking, goodness, I don't have $10,000. If it's $1, then it's $100. Is that correct?
That's correct. If it's $1, you spend $100 for your call. And if the stock is selling for $30 a share, you're controlling $3,000 worth of investments with $100. Now, if that $3,000 investment went down to $2,000, you would have lost $1,000 on that investment. Well, the most you can lose on your call when you're owning it is $100, because that's the premium you paid for it. Now, if that stock went the other way, we saw the leverage, and you can make a much higher percentage rate of return on the option, understanding that it has an expiration date.
And so when, especially if you're a Marie and you're thinking, goodness, I don't have tens of thousands of dollars to jump in here, what should a reasonable amount for someone to think about? Well, goodness, if I'm just getting started. So if I'm just either selling or buying, what's a reasonable amount? Of course, if they're selling, you don't necessarily need anything but to hold the actual stock. But if they were going to buy some options, are they thinking, goodness, maybe some options that are $1, $2, $5 a piece, something like that?
Yeah, if you're going to start in it, I wouldn't recommend selling naked options, because that, like we said, if you sell a put, then somebody has the right to put a stock to you at the strike price. Well, if the stock went to zero, you'd still have to come up with that money. On a call, you're promising that you'll buy it for your strike price, and that could go to unlimited. However high the stock can go. You'd be out all that money. So, but if you buy the option, then you're limited to that premium. And so if you're going to try to use naked options to start out with, I would start small with some calls or some puts, either way, but just on the buy side. Don't do the sell side. Then as you get used to it and you understand how these move, and you can only do it with money that that you can lose, because the expiration date's in there. If you're not using it for insurance, then you want to make sure you're using it with money you can lose. But in there, you can make an awful lot of money. And once you learn how those work, either get in touch with your advisor or get the book by Macmillan, and you can start to see how you can do spreads where you make money if the stock goes above a certain price or below a certain price. Or it's a straddle. Make a spread where you make money if the stock stays between two prices. There's a lot of strategies to do that.
Now, you brought up a good point about calling your advisor. Is this something that the ladies can do on their own, especially if they're just getting started, maybe doing something small?
You can, absolutely. I always recommend that you talk to somebody that knows what they're doing, that can take your hand and lead you through options, because options can be very risky. Remember, I had those two things up there. It can add risk to the portfolio, or they can detract risk from the portfolio. And you want to make sure you know which box you're in.
And then in terms of as they're picking stocks, now we're not going to tell you, do this stock or that stock or what have you, but are we thinking it's safer to start off with maybe large cap or small cap? So these are large companies, your Apples of the world, or some of your smaller companies, your developing companies, your Teslas and so forth. Do we have kind of a thought in terms of which one for the ladies that are getting started?
No, I mean, as far as an option, the risk when you're looking at a small difference between a small cap and a large cap is, when you're investing in the stock itself, and how that stock moves. And the small cap's going to be more volatile, certainly. And not all stocks have options on them. So there are some stocks don't have options on them. But if you have more volatility, that option is going to play a little better for you, if you're trying to get the leverage out of it. If you have a large company that doesn't move as much, then you're probably going to want to lengthen your time out because you want time for that stock to get through the price that you need it to get through.
And now we've definitely heard some, crazy things in the news. We definitely heard about the guy who, unfortunately, it looks like he had an unfortunate event where it looked like he owed like $70,000 or something like that from doing some of these calls. Are there platforms that you think might be safer than others? Or certain things in terms of the processing of transactions? We know that some trades settle in 3 days, 1 day, and so forth. So you aren't like biting your nails or going crazy on the side as you're looking at, oh my God, whatever swings may happen within a day.
Yeah. Now remember, we were saying that on say selling the options, that's where you get your big losses, and that's where that happens. On buying the options, you're still limited to your option premium on the loss. Whenever you're dealing with an option, you're not dealing with the person on the other side of that transaction. You're dealing with the options clearing corporation. And so as those trade on those exchange, the platform that can operate on those exchange should be fine because the platform's not making the market in the stock. When they're not a market maker. The Options Clearing Corporation is guaranteeing that execution.
Now we have another question. It says, how do the option strategy correlate to the advice given for the buy and hold people? So if you're a buy and hold type investor, how do you then incorporate option strategies into that?
Well, the two that we just went through are perfect for a buy and hold, because if I'm buying and holding, what I have at risk is my profit that I've held this stock for a long time. And that stock can go down significantly for any reason. Last March was just a very good example. And so if you're using those options, the strategies that we went through today, the put hedge for insurance, then if that stock that you're holding goes down, you don't have to worry and sell it now and get all that capital gain exposure. You can let that stock go down. You can close your option position and take the profit out in cash. Still hold your buy and hold long-term stock. Still hold that. So it is a very good strategy for a buy and hold.
So definitely for some of those ladies that are extremely conservative and they're like, nope, I bought these ABC stock and I don't plan on selling it, then that's another, so you can actually do some of those options as well.
As long as you're on the buy side of an option, you're the one that has control. As long as you're on the buy side of an option. It's when you're on the sell side of an option, I sell a put or I sell a call, I don't have control. As far as if the stock moves, I'm either going to have to close my option position or buy the stock or sell the stock, whichever side I'm on. But if you're holding the stock and you're using the buy, so I buy a put, I never have to sell that stock if I don't want to.
Now, are there additional things that the ladies should be doing as they evaluate stocks to decide, should I buy or sell an option on this particular stock?
Sure. Let's say you've got that stock like we were looking at that very last strategy, that you had a stock that you were waiting to come down. You knew it was going to drop another couple points, so you get people issue buy signals at buy it at 65, so the stock's selling for 67 right now. Gosh, I want that stock, but the buy signal's at 65. That's what I've charted. Well, instead, I can sell the put instead of putting in a stop loss order where it's just waiting for that stock to go through, and it goes through, and then that order automatically executes. If instead you sold the put when it comes through there, now that became an in the money put. Someone's going to sell you that stock at 65. It's the same way you would have had on that stop loss order in there, is that you would have bought it at 65 anyway. But instead of that, you've also got $2 that they gave you for the time premium, and that $2 then brought your net price on that stock from $65 down to 63. You paid 65, you got $2 in your pocket. Your net price on that stock 63. So that might be a good case as well. Somebody that's analyzing stocks saying, I'm going to buy it at this price, and do it on the put side.
Now, for the ladies who are more passive investors, so is investing in options, is that going to be something where they're checking it every single day? I know you talked about if they're in the money at the close, it'll just automatically go in their favor. But is this something that, goodness, if I'm trading options every single morning, I'm, looking to see where things are going and how the individual stocks are moving? Or is this something that somebody could set and forget?
Well, that's really where you want to use your advisor. You want them to have their eyes glued to the screen. That will tell you that, gosh, March hit. Let's go ahead and close our option position. Take out all this cash. Still have your stock, and let April, May, and June hit, and your stock go back up, and you've got more cash there. So yeah, it's something that you're going to want to watch. You don't have to watch it every single day, but if you want to eke the most out of it, yes, it's something you're going to be watching. Now, on the other hand, that other strategy of the insurance, you really don't have to watch it every single day, but when that stock, because you're watching your stock at some point, when that stock's below your insurance price, and so at that point, at any point, you can go in and choose to take that cash out and then reestablish another insurance base lower. So yeah, so you can kind of let it float if you're using the first strategy that we showed you.
Now, if you're selling a put, or if you're selling a call and someone can then take the stock from you or buy the stock from you, could that trigger capital gains?
It could.
Okay.
If you're using a covered call, that's why you make the choice. If you're using a covered call and the stock does go through that strike price, they are going to want to buy that stock at the strike price. If it's going to be at that, you have a intrinsic value. They can do it at any time before expiration date, but at least at expiration date, it will do it. But understand, they can take it from you in the middle of the time frame if they want. The option clearing corporation can say deliver. So when you deliver, you either have to sell your stock at that point. That would be your capital gains on the stock that you're holding is triggered, or you can go in and buy the call, which at that point you probably have a capital loss on that call because the call went against you or the other way. So you get a choice. I can either take a capital loss, keep my stock, take a capital gain, sell my stock.
I think this is good stuff. And it's just one of the many things that adds to. So if you're a buy and hold and you've been holding this array of 10 stocks and you're like, what else could I do with it? Well, you have some options of what you could actually do with it. You can buy insurance. So that's the option, or you can sell. And of course, then you do have a little bit of risk because someone could take your stock that means a lot to you or that you've held on forever. But you have a number of options. And so definitely some things are riskier than others. As Jim talked about, some things have limits to the amount of risk that you have. Some things only limit your premium as a risk that you'll have. And some things have unlimited risk. And we want to definitely know the difference between the two. So you aren't just simply kind of clicking around where sometimes things just seem so easy. And if you've had a good couple of transactions and then all of a sudden things go in the opposite direction. So it's great to just, if you're going to start off, like Jim said, to start off as kind of that insurance policy type start. And then as you continue to get comfortable and as you're doing better with your evaluation of the underlying stocks as well, so you'll know what direction do you anticipate. And unfortunately, none of us have a crystal ball. If we did, then someone would be rich. Hopefully it would be me, but but we definitely want to make sure that you're doing things within your level of comfort and within your level of risk tolerance, and you aren't getting aggressive and treating it almost like you are at the casino, because the losses could be massive.
That's right. And Rosalind, if anybody wants any more information on it, I'm sure they can contact you. You can give them my contact information, and I'd be happy to answer any questions that anybody has.
Perfect. I'll drop your information in the chat. And I want to thank you, Jim, for this good information. Really and truly just understanding the basics, because if you're looking at the news, you're checking out social media and all of these experts, I always say, when the market is up, everyone is an expert. I remember years ago where everyone was a real estate expert, and now everyone's a expert stock picker and so forth. You want people who are able to have a conversation with you who've actually weathered a few storms, because unfortunately there will be a new expert in something else 10 years from now when they've decided, oh wait, this wasn't as lucrative as I thought it would be, and now they're an expert on whatever else it might be. And so definitely to look at experts who have weathered a few storms, who've gone through a few market cycles, so you can really kind of stick your toe in, get a good understanding of what you're doing, and decide if you want to then take on more risk, but not so much that it could jeopardize your future plans, your FI journey, and so forth. So I just want to thank you so much for this information, Alicia. That I'll definitely get you over the recording as well, so you'll have all that information. And ladies, remember that the recording of this information is always in the announcements tab of the group, so you can always go back and check it out and make sure that you get all of your answers, all of your questions answered. And Jim's information will be in the chat as well. I want to thank you so much, everybody, for joining us, and have a wonderful Monday evening.